it's positive on one way. I mean, I think there's a danger that there's been sort of an overreaction of regulation. I mean, it's not just AIFMD, it's EMIR, which can, if you're subject to AIFMD, you're probably going to have to sort of collateralize your obligations under derivatives with effect from the middle of next year. There's a whole Solvency II thing, which is changing the way that insurance companies invest. And there's a lot of uncertainty, which in some ways isn't good for investment. And also the more regulation that's imposed, the more in some way it creates very similar investment behavior, because everyone's got a similar sort of focusing on different types of asset classes, got a particular capital treatment for regulatory purposes. So on one level, you could say it sort of almost theoretically increases systemic risk. But there's certainly a lot of it going on.
Definitely. You know, there are three types of real estate vehicles in Germany. One, we see the open-ended funds, we have the listed sector, and we have the closed-end funds. The closed-end funds were largely unregulated, so-called grey market, and they are actually quite happy to be regulated now. In the end, a number of players will die, but the surviving ones will definitely be stronger. And they will be part of a harmonized European capital real estate market, which I think they appreciate very much. In the same way as the professional institutional side appreciate that there is a European regulation, and they do not have to deal with 10 or 15 or 20 different sets of regulations. I think there are a number of more benefits, I think, for the real estate sector, but the downside is that they will have to deal for a number of more years, not only 3 to 4 years, with a constantly changing a learning process on the European community level and a constantly changing regulatory environment. But they will have to. I think they will be able to manage this.
Okay, good. Alex, do you have a view on that?
I mean, again, I think it's in the listed sector, it's as much transparency as regulation that's been the key thing. And actually what we do find in the listed sector is that you have a certain level of peer group pressure. So without naming names, but let's call them British Land and Land Securities. So if one, for example, comes out with a quarterly evaluation and a statement, then you can guarantee that within 3 months the other one will. And so the level of disclosure gradually increases, which we view that sort of step functioning as very positive, because it's clearly in response to investor demand, and higher levels of disclosure are greater. I guess my issue with the whole regulatory framework is that, you can end up with unintended consequences, you can end up muddying the waters, and you can end up, frankly, with a system where people say, this is so complicated, I'm just going to bypass the entire thing. Rather than having a simple, straightforward way of regulation. But broadly speaking, real estate has been an unregulated activity in general terms outside of the scope. And it's absolutely right that it should be brought back in because, as I mentioned earlier, if we're looking at real estate allocations going up from, say, 5 to 10% or 10 to 20%, then it needs to be able to comply and compete. And if it doesn't have the regulatory framework there that people are comfortable with, then they won't allocate the money because it doesn't comply. So that's my view, that it's not necessarily a positive, but it would be a negative if they didn't have it. Let me put it that way.
Right, okay, so then that puts it on a par with, let's say, equities or bonds, so that then that allows more of that capital to increase. Absolutely. Okay, fine, good.
If I may add to this, definitely if interest rates are increasing, but right now, the real estate is such an attractive asset in Germany, at least, that I do not share this concern. But as soon as interest rates will be increased, of course, bonds and all this will become more interesting.
One of the things we see is sometimes sort of European insurance companies investing into a particular product, and they all have at the moment their own separate rules in terms of eligibility. For example, German insurance companies looking to invest on some joint venture basis or some co-investment basis may want to try and get the investment put in what's called the real estate quota box as opposed to the equity box. And quite often when these things are structured through different corporate vehicles, it's not possible to do that. And that does impede the investment process. So I think having more consistent rules will help in that respect as well.